Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kessling, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Hey everybody, welcome to the Absolute Return Podcast. On today's show, we welcome special guest, arcMacro's founder and chief economist, Dylan Smith. Having served as an economist at Goldman Sachs and Rosenberg Research, and later as a private market consultant at McKinsey, Dylan understands exactly how macro forces translate into the long horizon, illiquid world of private equity and alternatives. On the show, we discuss the current conflict in Iran and its effect on inflation, persistent government deficit spending and the implications for bond investors, what asset class he is most worried about, which segment of the market provides the most attractive mispricing, and more. So with no further ado, here's our show on inflation, war, and the new market regime with arcMacro founder Dylan Smith. Hey Dylan, welcome to the show. How are you today?
Thanks so much for having me, Julian. I'm very well today. Thank you.
Great. Calling in from beautiful Toronto. Unfortunately, didn't make the playoffs this year, which I guess is as to be expected, but hopeful for next year. That said, you're a macro specialist at arcMacro, and there's obviously a ton going on right now. In particular, for context, April 20th, on again, off again, Middle East conflict with Iran and oil prices going crazy, particularly today and over the past several weeks, and equities volatile, credit's interesting, commodities interesting, so a ton to chat about currently, but I wanted to set the stage focusing on the current macro regime and your view of it.
Yeah, so I think a regime is a good place to start because that's really how we try to think about the world at arcMacro. And maybe just to give you a bit of context on how we do macro and how we think we do it a bit differently, we really like to think about, for all the things you just described about the world moving very, very fast and markets, repricing on the strength of a single tweet or truth post, very quickly. We try to look through that a little bit. We're more focused on longer hold portfolios, institutions managing across public and private markets, where you're trying to take a view on the world that, is a bit more durable than, how a shorter term trader or a hedge fund, might think about playing the markets. This is more about how do you create long-term value and how does a good macro thinking fit into that. And the way that we approach that is, we really try and distill all the data down from, macro data, alternative sources, market data, into really sort of three main factors. What's activity doing? What does growth look like? What's happening in the real economy? Are firms expanding production? Is investment happening or not? And then what are prices doing? So, that's really about inflation, high or low. But we tend to look at that on quite a disaggregated industry level. And then what are financial conditions doing? Are they enabling growth or not? Are interest rates high or low? Are spreads high or low? And, what type of impulse is that imparting on the economy? And when you can simplify it down to just those factors, there's only a finite number of combinations you can have in terms of, if you think about stuff being a few standard deviations above or below the historical trend, you can start to package the economy into a few different states. And we've already come up with 7 that we think are fundamental. I won't go through all 7. I'll tell you in a second which one we're in now. But what's useful about that is then you can look at it and say, okay, different regimes imply different things about different asset classes. And in certain regimes, you'll want to be, way overweight in, say, rates or credit. And in other regimes, it's more of an equity risk-on type of macro setup. And so that really helps you when you look over an entire portfolio to think about those kind of allocations and that risk management. Right now, we're in a scenario that a regime that we call sluggish. And this is mostly talking about the U.S. economy, but it can probably apply to Canada as well and to most of the world. And what's interesting about this is when we run the data back to as far back as 1970, 1960, it's a quite unusual regime, right? This is where growth is. It's not negative, it's not recessionary, but it's below potential certainly, and below the long run average. it's moderately inflationary, but inflation is not like spiking. We're not seeing what we saw in 2022. And yet credit conditions are very easy, right? We've seen that in equity prices on average over the last few years. And usually this is a transitionary regime. Usually it's fairly short, lasts a year or maybe less. And it's what you get as you're either coming out of a crisis or going into a crisis. So everyone who's feeling that the US economy for the last 2 or 3 years has been kind of teetering on the edge, we're seeing that in the data as well. And that's the regime we've put it in. But the difference this time is it's lasted a very long time. And you expect it to resolve one way or the other, right? So you've had all the kind of bears seeing a lot in the data saying a recession's coming. You've seen markets certainly pricing a different outcome. But, there's been constant shocks that every time it looks like it's breaking one way or the other, something's happened. So there was a huge fiscal impulse and a huge amount of COVID savings that was spent as the economy was weakening, which prevented a recession. You got interest rates coming down at just the right time. And then every time the economy looks like it's gonna accelerate, you get some kind of boneheaded policy that again. So this time last year, things, financial markets were very excited. Lots of indicators saying things are on the up, and then Liberation Day tariffs hit and put an end to that for a while. And it's been the same this year, where we were seeing a lot of good signs in the early part of the year that labor markets are settling and even accelerating slightly and improving slightly. Immigration has a lot to do with that in terms of bringing supply down at the same time that demand's sort of staying solid enough. You're seeing deal flow pick up in all sorts of industries, capital starting to be allocated, and then the Iran war shock has happened and everyone's hands off again. And so we're back to sluggish. We published a note a week before the war saying it looks like we're entering what we call a Goldilocks regime, where growth picks up more to its long run average. Inflation, we were worried about upside risk, but weren't seeing a big inflation surge happening just yet. And still easy financial conditions, which is a great time to be investing and a great time to be in risk on assets, especially. Just as we published that, the invasion or the strikes happened. And so we're sort of back to this in-between regime where we're waiting for something to resolve one way or the other.
Yeah. Chaotic foreign policy, certainly keeping you on your toes. And with that sluggish macro regime, it's interesting because you discussed below potential growth in the U.S. economy. And just like hope springs eternal with Toronto Maple Leafs fans, it seems to be a similar case for equity investors and the productivity potential of artificial intelligence, which continues to be the bull thesis, but really hasn't played out in the numbers. And you just hear about, amazing sort of step change available with new releases of Claude or ChatGPT, and it's just not showing up in the numbers. And it makes you think, is it ever going to show up? But with respect to your sluggish regime call, what do you think is the most misunderstood macro force in markets today?
Oh yeah, that's an interesting one. I mean, that's when you think about it. In terms of misunderstood. I mean, one thing I think gets a fair amount of attention, but I don't think is being thought about necessarily in the right way by markets is where fiscal policy is right now. So when you do hear about it reported, it's kind of this sort of very nervous tone on long-run fiscal stability, which I think is valid in most places, right? You're seeing developed market debt levels kind of pushing up towards 100% and a little bit beyond. And, outside of World War II, that's basically unprecedented. And so I think markets are right to be long-run nervous. And I think there's a pocket of assets that affects. But you hear much less about the near-term growth impulse that's having. And it was, if you just kept that in mind, it was very easy to understand why the US has outgrown Europe and a whole host of other countries because, they've been subject to an enormous fiscal impulse. It's changed form. Under Biden, it was a spending impulse. Under Trump, it's been a tax-based impulse, but it is large. And it's large enough, I think, to, in normal times be, in our language, be pushing the economy out of the sluggish regime if it was allowed to. And so that's something we think, is being underappreciated. It also has inflationary implications, certainly in the long term, but also in the short term. And that's where we think something a little bit overlooked is even before Iran, just the generally inflationary feeling around the U.S. economy, which I think was being missed by people. And I think, we were seeing a lot of rate cuts priced in. We were seeing the Fed deciding not to prioritize inflation for a while. And, I don't think that necessarily puts inflation back at 7%, but I think it can very easily lock in 3.5%, 4% inflation for a couple of years and become very uncomfortable. And so I think that's something as well that people have been overlooking.
Now, you mentioned two things that are really top of mind for me, one being persistent deficit spending and implications for the bond market. And the second, inflation. I want to touch on inflation first because you mentioned the outbreak of war in Iran, spiking oil prices and commodities. So things certainly went the complete opposite way of what the Federal Reserve was expecting. Markets had penciled in 2 rate cuts this year, and then new chair Kevin Warsh, I think, going to have a tough time getting the FOMC on board with any sort of rate cuts this year. That said, with where oil is in commodity prices, aluminum, copper, etc., what's your outlook for inflation, even if things do settle down in the Middle East?
Yeah, I can easily see core inflation going above 4%, even above 5%. So I'm pretty nervous about where we are on price levels. There's a few reasons for that. I mean, if you just take as your starting point a normal oil price shock and you run some very basic regressions, what it spits out is that if you see prices, or for every 10% increase in oil prices, you should get a quarter of a percentage point of headline inflation on that. And so if we sort of extend that to where we are now with, say, a 40, 50% price spike for 3 months, that's going to put you at about a percentage point of inflation, which is what we're starting to see in the March data. Now, the longer that persists, it kind of gets up to a certain, peak level of more like 2 percentage points. And so that already gives you headline inflation of around 5%. Now, the two big questions are, how is the shock different? And how does it get down into core inflation? And I think that's where there's maybe a bit of complacency around. Firstly, because, I think everyone's pricing good news on the Strait of Hormuz as if once it's open, it stays open.
Right.
I'm not seeing much consciousness of the fact that it might be permanently tolled. You might have constant disruptions to traffic in the way that you did around the Red Sea when the Houthis were attacking ships, saying nothing of insurance costs. It's saying nothing of the higher cost of storing hydrocarbons in the region because of potential for attacks. And so I think we should be treating that region as, fundamentally potentially unstable at any point because of how much Iran has learned about its leverage in the region. And so I think that's one reason to think that, if oil prices do start to tick down a bit, they don't have very far down to go because, we need a long proof period before markets can truly normalize around it, or for infrastructure to be built to kind of de-risk the Gulf a little bit and move alternative sources, which is a few years out anyway. So that's one reason. Another reason, of course, is that it's not just oil. A lot of important byproducts are produced in refineries in the Gulf. That affects fertilizer prices, it affects plastic prices, it affects all sorts of industrial inputs that, other types of oil price shocks haven't had that, right? So when oil prices surged because Russian supply was taking off the market, that was just Russian crude supply to certain regions, right? It didn't affect fertilizer prices, it didn't affect plastics prices because that was all being produced in the Gulf. So we're going to see a much broader price hit. We haven't started seeing it yet, but that's, the longer the Strait stays closed, the more that comes. And we're hitting a point where physical shortages in certain parts of the world are going to become a reality in oil, in refined products, and fertilizers. And that can send prices even higher. So the shock's not done yet, is one thing. But then the other important thing, I think, is that behavior changes. And this is an overlooked thing. But we have a way of looking at the producer price index data that tells you whether or not firms are expanding or contracting margins. So it actually separates out like what's that physical goods inflation component and what's from how firms are deciding to adjust or not adjust margin. And we've seen since, over the past year, we've seen margins contracting as the tariff shocks have been absorbed along the value chain, right? And we know also from company statements and from the Beige Book and other types of data that that's happening. Now, you're a CEO of, some kind of manufacturing firm in the US. You desperately want to increase prices because you want some margin recovery from that tariff hit, but your customers aren't letting you. And then oil prices spike and you say, guys, sorry, we have to raise prices. And actually what you're seeing in the data is that not only are prices going up, but margins are going up too. So there's some margin recovery happening, and that's adding into the sort of inflation inflationary environment beyond what the oil price shock is doing. So, I'm not a big believer in how we measure inflation expectations. I think calling a bunch of consumers and asking them where they think inflation will be, it's basically just wherever inflation is now.
Right.
But if you survey firms and ask them, what are you doing with prices in the next 3 months, 1 year, that's a pretty solid measurement. It's less easily quantifiable, but that's starting to really move up. And so I think, that is why I think there's going to be some broad-based inflation coming through above and beyond, what gas prices would do to inflation normally.
And this is within the context of 6 years, the U.S. inflation being above the 2% target. And you think about the Trump administration's objective in getting interest rates lower, getting inflation lower, in contrast to some of the chaotic policy, trade war, tariffs, war in the Middle East, and all of those dynamics move things the opposite way, as you indicated with your outlook for inflation. So with that said, what are your thoughts on not only what the Fed can do this year, in addition, global central banks, because you're really seeing this on a global basis? Are they going to be able to, not just cut rates, but I think right now the market's concerned about just keeping rates stable and not hiking?
Yeah. So what we've seen going into the war, there was an expectation that rates were going to come down a little further. Now, I think that underestimated inflation risk that was already there. But, okay, so the Fed was close to neutral and it was going to get sort of on its estimate of neutral. And, Walsh would come in and keep Trump happy, say thank you for putting me in the position, might give him a rate cut or two, and then actually really decide what his policy was for the next few years. Like that probably wasn't going to send inflation soaring, even if you were worried about inflation risk. As soon as oil prices crossed 100, those 2 rate cuts got taken out of market pricing immediately. Although interesting, the probability of a hike by the end of the year was almost zero also. So everyone just sort of crowded around this idea that the Fed's going to be a little bit stuck. And the same with global central banks. The UK easing cycle was priced out. And hikes started to be pricing in for Europe, who are facing that gas price shock as well, and are generally more conservative. What I found very interesting was, given what I've said about inflation and how even with the straight open, you don't really know that inflation is not going to continue to be quite high. As soon as we've had these few days where it's announced that it's open before it closes again, you get a rate cut to be starting to be priced back in for the end of the year.
Right.
And I think that's kind of interesting, but also probably a bit of an oversight by markets and something I'd see as kind of an opportunity for anyone operating in that space. But yeah, it's a very hard time to be a central banker when supply shocks hit, because you have to be conscious that you might be in a situation where growth slows, labor markets weaken, and inflation surges. But there was a real lesson in the supply shock of COVID, which was that, if you do not act in a hawkish manner and, basically communicate to markets, we are extremely observant of this risk and will act as soon as we need to, you start to get activity kind of responding and inflationary pressure rising outside of the supply shock, right? So part of the job of central banks talking is to act tough enough to say, like, we will impose pain if we have to, essentially so that they don't have to, right? So that you don't get this behavioral type of pricing that I've been talking about. And the risk for the US economy is that the Fed is once again too dovish, too focused on transitory shocks. Even though the shock does end up transitory, it doesn't mean you have to talk about it that way. And that's the communication challenge that central bankers are sort of always facing.
Yeah, and it's certainly not unprecedented. You see what Alan Greenspan did in terms of warning about equity prices. Was that in the late 90s? But then in the 2000s, keeping rates probably way too low and effectively spurring the housing bubble, which ended in disaster. And I see potentially some of the same mistakes being made. Now, another dynamic that you mentioned that should certainly be on investors' radar is persistent deficit spending in the United States. Current deficit, I think, around 6% of GDP, which is really unprecedented outside of war or massive recession. And I guess, technically there is a war now, but this spending was happening before that. And there seems very little imperative to reduce that budget deficit, not only in the US, but you're seeing massive kind of, federal and government debt. You look at Japan and a good case study there, but focusing on the United States economy and the largest bond market in the world, what, if any, do you think this persistent deficit spending and exploding government debt throughout the world, is that ever going to have an effect on the treasury market? The so-called Minsky moment, if you want to refer to it as that.
Yeah, well, I find it difficult to see that type of moment happening in the U.S. economy. I don't think it's impossible, but I think these types of issues, if we learn anything from Japan and other very large economy debt problems. So I've worked on debt blowups in small economies, and that's a whole different dynamic. It's almost more like a company blowing up. But for the U.S., this enormous provider of most of the world's liquid financial assets, it's a bit more difficult to see that happening. And the much more likely scenario is just a steady grind towards a worse and worse situation until something gives, either policy-wise or otherwise, to deal with that pressure, right? And so, if you think about kind of what are the ways out, right? There's this big deficit. I'm always fascinated when I speak to politicians about this because I say, like, do you guys know what you're saying? Like, what are you? Why aren't you acting on this, basically? And the answer is always some form of, well, we have immediate political pressure right now.
Right.
And, if this becomes a bigger problem, we'll deal with it then. And that short-termism is not a good mix for this kind of thing, because when this becomes a problem, it's probably too late to properly fix without avoiding some economic pain. And so, okay, so what are your options to deal with that kind of thing, say if the political will eventually emerges to do that? Well, the great way out of it, which is what I think everyone's hoping for, is that you just get this awesome productivity boom kind of growth surge where growth picks up like durably to 4%. Tax revenues are just rising on their own. And, you can still spend quite high, but the budget deficit comes down because of that kind of organic thing. I really hope that happens. If there's anywhere it is going to happen, it's probably in the US first, because I think adoption of AI by firms is much quicker. And there's a sort of culture that, might enable that in the States. Whereas if you look at other very highly indebted countries, say in Europe or in Canada, much more frictions in the economy towards adopting those types of technologies. And so probably would be a little bit more difficult. But, you mentioned productivity up top, and there's the famous quote of, you can see it all around you except in the numbers. Productivity is something that is very, very hard to measure, for one thing, and it compounds like interest rates do. So a small amount of productivity growth spread across 5 or 10 years can actually grow the economy and standards of living a lot. But you don't really see it as this like big structural jump in the way that, the oil price tripling would really structurally change the economy very, very quickly. It's a much slower kind of effect. But, if you think about how different the world was 30 years ago and how much more productive we are, like it's, the internet's definitely done stuff, and cloud computing and all these things have definitely changed how we operate and made us more productive. We've just spent most of that productivity on things. So that's one thing. Maybe there'll be some growth, maybe not. The other way is to actually deal with the underlying problem, which is that Western developed countries have run out of fiscal space. The budgets, there have been years of commitments to welfare spending, which, whatever your political views on that, a fact about them is that they are sticky. They're not something you can easily adjust through the cycle. In fact, they tend to be pro-cyclical, and that usually have to spend a bit more on welfare when things are getting bad. And so you see this in the public debate. It's starting to emerge as a serious thing now in places like Canada and the UK. If you think about what's committed to welfare spending, what's kind of locked in government spending that you can't really avoid in other things. In the US, you add the military on top of that, and your wiggle room actually becomes very, very small. And, since COVID, there's been a huge amount of pressure to spend that wiggle room to sort of support the economy. I think it's evident in how sort of Trump operates. There was basically no case for a tax cut from a pure economic standpoint when he made the tax cuts, but he made them.
Right.
We're seeing, the Carney government is coming in and really putting the economy first in Canada. It's not bringing spending down very much. There's some right sizing of the public services, a few other things, but they're going to spend some of the oil windfall and give it back to consumers. So it's just such an easy thing to do as a politician, and just kind of keep the can down to later. So renegotiate the social contract. We probably should be doing it. That's not going to happen. It's too political difficult. So your third way out is to inflate.
Yeah.
It's to allow a certain level of persistently high average inflation to bring down the relative value of government debt compared to GDP. And so I think bond markets are seeing that. If you look at where the inflation premium is on 20-year, 30-year paper, there's a big inflation premium in there because, over that time period, I don't think you can build in 2% inflation. It's probably going to be 3 or 4%.
And it appears with your thesis about central banks potentially running it hot, which looks like, politically, perhaps the only way to get out of the quagmire that they're in. In that scenario, what assets are best positioned to capitalize on that? What would do the best in that scenario?
Yeah, well, that would reverse a very long period of great performance of fixed income, right? So, we've seen as from the 90s onwards, basically when central banks got a hold of inflation, when they started inflation targeting, when they said this is our main aim, and managed the economy with the goal of keeping inflation stable. And they got a huge amount of help from Chinese production coming online and really reducing the cost of global goods production. That's been a great time for bonds. And interest rates got all the way down to a decade around zero, basically. That world's over, I think. That world's over. And so I think that's, you got to find assets that will hold their value through a period of sustained inflation. And that's equities with pricing power, I think. And that's part of, I think, why valuations have picked up a little bit on average in equities. Yeah.
Now, conversely, it'd be interesting to hear where you think the market is complacent. We spoke about probably the most appreciated risks: inflation, deficit spending, war, commodity prices, supply chain, etc. But are there any hidden fragilities? There's some known unknowns, unknown unknowns, some stories in the news, whether it be, potential AI bubble and what happens if that capital expenditure boom reverses. Should people be worried about private credit? Are there cockroaches there? Is it going to be another 2008? Even the Canadian housing bubble seems to burst and no one really cares. And it had very little effect, I guess, on Canadian equities or the Canadian economy. Are there any hidden fragilities in the system or things that you think the market's being complacent on?
Yeah. Well, I think the AI one everyone knows about. I think it's, everyone remembers dark fiber from the 90s and, knows that you can overbuild. It's difficult to picture based on, how much usage is expanding and, all the AI firms are constantly kind of running out of compute. We don't know where the tech's going. Maybe someone invents just incredibly much more efficient AI way of doing AI that invalidates, half the GPU build-out that we've had. Who knows? But I think everyone kind of understands that that's a risk that's there, and that would be, pretty negative for markets if that materialized. Ones that are harder to spot, I think private credit's interesting because there is a story there, but people are getting it wrong in terms of what the story is. So I think the current problems we're seeing there is essentially an issue with the retail-focused private credit model, where we've seen private credit firms have set up semi-liquid funds. They've tried to attract mostly high net worth retail investors. They've said, look, we outperform banks. This is a boom time. Institutions are doing great. But, these investors don't have the patience of institutional investors. And they're a bit more sensitive to what's in the news. So they see 2 or 3 private credit firms blow up. They call their advisor and they want their money back. And so we're seeing things gated out. Now, probably defaults will go up. And it's possible that some of that will happen in software where private equity is over-indexed because, there will be firms that just get wiped out by AI. There are other firms that will do incredibly well in ways we don't understand yet. But probably you're dealing with a slightly higher default environment. Okay, fine. That's cyclical and probably manageable. It doesn't mean the whole economy blows up. And the other thing about private credit is it's still mostly institutional. And so, and it's locked in. And so even if funds underperform and defaults are higher than you expect, you just get institutions marking down their book. It's not like this massive chain of collateral blows up, or suddenly the banking system's in big trouble. It's like returns of pension funds are suboptimal, which is not good for everyone, but it's also not a crisis. I think what we might be missing a little bit, especially in the US, is collateralization is back. And it's kind of the bit that's like semi-linked to private credit. It's not purely about private credit. Some collateralized lending is more in private space. A lot of it's more actually in the banking space. But there have been a few kind of innovations around market structure in terms of, factoring receivables, and it's murky. It's, this is why there's been some comparisons to 2008 where it's just hard to say what the kind of leverage chains look like and whether banks are actually significantly exposed or other financial institutions are significantly exposed. So if I was like a regulator, I would be looking quite hard, not at private credit so much as how is the return of pretty high levels of securitization affecting the rest of the banking system. And the Europeans are on this actually, but it's bigger in America and it's less regulated in America.
Right. And I think your thoughts on private credit and what's happening there really nails it. If people are going to make the comparison to the GFC, and you got to realize that you look at Lehman Brothers, it was levered like 30 to 1 or 50 to 1, and these private credit funds are levered maybe 1 to 1. Yeah. In addition, you spoke about the matching of assets and liabilities, whereas Lehman Brothers had the liquidity sucked out almost immediately, as you see in a banking crisis. And in the BDC space, you really don't have that asset liability mismatch, which really creates the problems when you combine it with leverage. And it is an interesting concern around CLOs and the structuring of broadly syndicated loans and even private credit loans as a market that has grown significantly. And I think without a lot of attention, and it's sort of to be seen what's going to happen there, but it's certainly worthwhile monitoring. Now, that said, Dylan, I have one last one for you prior to letting you go. You mentioned feeding in with your global macro thesis. You mentioned equities with pricing power as a good place to be. Well, with that said, do you see any big asymmetry if you put your asset allocator hat on? Is there anything that's massively mispriced? Is there any indicators that people aren't paying attention to? Where's kind of the highest potential opportunity?
Well, can I give you an opportunity and a concern?
Yes, definitely.
I'll start with the bad one so we can end on a more positive note. But I'm a little worried about gold. Okay. I did some talks at the beginning of the year and kind of, did the classic hands up, who thinks this or that asset price will be the best performing asset price this year. And this was with retail advisors. And gold was by far going to be the best performing asset this year.
Oh, wow. Interesting.
And I've been looking at it kind of ever since. And, there's something interesting happening in gold, which is that it is now positively correlated with risk sentiment.
Yep.
It is a risk asset at the moment. It won't always remain that way, but the scale of the appreciation in the last 2 years, the change in the investor base, the interest from retail and day trading investors at its current level is making it a risk asset. And the reason that that's a bit concerning is that it is still being held in a lot of portfolios overweight because of the appreciation as a hedge. So what it's doing is it's basically, there's all these portfolios that have passively increased their allocation to the factors that drive equity through their gold holdings. And so they're not as well inflation protected as they think. They're not as well protected to downturns as we think. I mean, if you look at how gold's traded through the war,
not good.
Well, whenever something inflationary has happened and oil prices have surged, gold is down.
Yes.
And when the straits open again, somehow gold's up, even though oil price is going down, which is not the right way around in terms of holding gold for geopolitical risk offsets and inflation protection. Right? Something else is going on there. So I'm cautioning people to be a little careful with gold at the moment. If you want to take the risk, that's fine. but understand it. It's not a hedging asset right now. In terms of opportunities, I quite like software. I like it as a sort of fresh investment. So private equity going into new software, theses that integrate a good AI perspective. And I even like it as an undervalued stock at the moment. And that's just because of how the sell-off happened, right? It was completely indiscriminate. Some random research firm puts out a note and says, software's over. Most software firms are pretty quick moving and able to, they're kind of the first places that deal with these shocks, right? So there are a lot of, I think, high quality companies that have made the transition to cloud very effectively, that are now thinking hard about how to make the transition to AI and how to put AI into their business efficiently. I do not think LLMs solve every problem. I run a small business. I would not trust Claude because it is good as it is with like my entire CRM and my entire sort of finance infrastructure. I might let it do some little analyses, but I'm not handing it the keys, and I'm not telling it to build me one from scratch either. So I think that move has been overdone and it hasn't quite reversed yet. I think it's a stock picker's dream out there for software. Anyone who's like well clued up on AI and can really understand sort of who's leading, who's lagging within each subsector of software. I think that's a really, really interesting space, and there's a lot of value sitting there. There's a fair amount of risk as well, I'll concede, but there's a lot of value sitting there as well.
Great. And listeners of the show would know that my views align with yours. I think it's a good contrarian bet. And, I'm not about to vibe code our CRM either. That said, Dylan, amazing views. Thanks for coming on the show today and chatting macro. It's always a very interesting space with so much happening. Who knows? Maybe tomorrow they'll reopen the strait and oil will crash. But unlikely, but we'll see. It'll keep us on our toes, right?
Thanks so much for having me on, Julian.
All right.
It was really fun.
Bye, everyone.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.